I'm going to share with you 11 ways to earn tax-free income on investments in Australia. From bonds, cryptos to stocks, these are the legit smart tax moves that the rich use. And no, you do not need to be rich to use any of these strategies. A lot of it is 100% tax-free and others help you pay a lot less tax. If you're new here, I'm Veronica. My legal disclaimer is that I'm a board-certified tax accountant in Australia. That said, these 11 strategies are general information only. As always, I recommend you to speak to a financial planner or do your own research before executing any of these strategies. All right, let's dive in. Strategy number 1, the 10-year rule investment bonds. This strategy is a gem and it is way underutilized in Australia. Here's how it works. So you invest with an investment bond provider such as Australian Unity, Generation Life, or AMP. Your money is invested in your chosen investment option. So before picking a bond provider, I recommend you to check out the investment menu and select the one that suits you. Your chosen investment will obviously make earnings, and one of the benefits of this strategy is that the fund provider will actually pay taxes on your behalf. Therefore, you don't have to pay taxes on it. And you do need to satisfy the 125% rule by not contributing more than 125% of the previous year's contribution. For example, if you contributed 10K in year 1, then in year 2, you cannot contribute more than 12.5K. After 10 years, you can withdraw all the earnings and the principal completely tax-free. Now, this strategy is ideal if you're a young family looking to save money for kids' education or a home loan, or if you're planning your estate. Now, unlike assets distributed through a will, which can be contested and take a long time to settle, the beneficiary nominated in an investment bond are legally binding, so it can be settled as quickly as within 7 days. And this strategy is also great if you're a high income earner looking to pay at a flat rate of 30% instead of 47%. Number 2, use lower tax brackets through family members. If your adult family members earn little to no income, you can legally hold investments in their name and their income get taxed at their lower tax bracket or even nil. So the current tax-free threshold in Australia is $18,200. But you can earn up to $22,575 tax-free, or if you're a senior receiving Centrelink pension, you can earn up to $32,279 completely tax-free. And you wonder how or why? Well, thanks to the low income tax offset and the senior and pensioners tax offset here. Aside from capitalizing the mentioned tax-free threshold, you can also benefit from the lower tax tiers or brackets. An example, say if your salary and wages is $150,000 per annum, that puts you in the first 4 tax brackets. And if you intend to invest, why not hold the assets in a family member's name who falls under the second tax brackets? As any dollar earned between $22,575 to $45,000 is taxed at a flat rate of just 16%. Please be cautious though, because once the asset is in their name, they can legally run away with it. So this is all about trust and planning. So I'll leave you with quantifying that, okay? Strategy number 3. Negative gearing. Australia is one of the few places in the world where negative gearing is broadly used. So what is negative gearing? Negative gearing occurs when the total rental income is less than the cost of owning an investment property. That creates a rental loss. For example, if you rent out your investment property for $25K a year and your actual cash expenses for interest, insurance, council rate, etc. total 15K, or ahead 10K in real cash flow. But thanks to depreciation and capital allowance expenses, it allows you to deduct another 22K. So on tax return paper, you've made a 12K rental loss. You can use this 12K to reduce your other income such as salary and wages. Mind you though, this only works for properties that grow in value. So don't use this tactic on dead-end properties, okay? Strategy number 4, debt recycling. Now, debt recycling is a financial strategy where you use non-tax deductible debt like interest on your home loan and replace it with tax deductible debt. Here's an example. Say you've got a home loan and you pay an extra 10K off your mortgage. You set up a split loan facility and borrow that 10K again and invest it, say, in a blue chip stock that pays dividends. Since the 10K is used to generate dividend income, which is taxable income, the interest on that 10K is now fully tax deductible. You can then use the dividend income to pay off your home loan faster or repeat the same cycle. It's really up to you. But please remember, this strategy involves market risk, so speak to a financial planner first, okay? Strategy number 5, focus on growth stocks with modest yields. Here's the deal. Dividends are taxed in the year you receive, regardless whether you receive it via cash or dividend reinvestment. But with capital gains, that's deferred until you actually sell the stock. So to those of you who don't know what a dividend is a portion of a company's net profit after tax paid to its shareholders or owners. So instead of chasing high dividend paying stocks, consider investing in blue chip companies that reinvest its profits for expansion and growth. You get less dividend income now, but more capital growth on your shares over time. And if you hold the stocks for 12 months or more, you qualify for a 50% discount on capital gains tax. Strategy number 6, realizing capital losses. In Australia, CGT events occur when you sell assets such as crypto, bonds, units, stocks, and properties. And the capital gain or loss occurs when you hold an asset for 12 months or more. So if you've got capital losses, you can use that to offset against capital gains to reduce your tax bill. And capital losses can either be from the same year, like this year, or carry forward from prior years. So let's say if you sold 1,000 Apple shares for $20 each, you bought them for $10 each and held them for over a year. That's a $10,000 capital gain there. And you also have a $5,000 capital loss carry forward from prior years. You can offset that $5,000 capital loss against that $10,000 capital gains, reducing the gain to $5,000 before applying the 50% CGT discount. This brings us to strategy number 7, the 12-month ownership 50% CGT discount. In Australia, if you hold an asset for 12 months or more and sold for a gain, you qualify for a 50% capital gains tax discount. So using the same scenario from strategy number 6, after applying the $5,000 capital loss, you're left with a $5,000 capital gains. And since the asset was held for more than 12 months, you now get an additional 50% discount, meaning you'll only be assessed on $2,500 of net capital gain. Please note, if you don't have a tax accountant and you're doing this yourself, you must always apply the capital losses before applying the 50% CGT discount. Strategy number 8, utilizing short-term losses. If you sold assets held for less than 12 months for profit, you can reduce this short-term profit by applying it against other short-term losses. So let's say you have a short-term profit of 10K and $6,000 in carry forward short-term losses. Your short-term profit is reduced to 4K. However, you will not be qualified for a 50% discount because you have held the assets for less than 12 months. You will be assessed on the full $4,000 with no 50% capital gains tax discount. So if you want to get that 50% discount, timing is key. Now, some people get really creative and sell assets at a loss to offset gains. Please be careful. The ATO closely monitors wash sales, where shares are sold to trigger a loss then repurchase shortly after. This kind of sale is seen by the ATO as artificial and tax motivated. So if you try to do this, the ATO will disallow the loss and maybe even penalize you. So please don't do this. Strategy number 9, time the sale in a lower income year. If you're planning to sell assets, consider doing it in a year where you have little to no income. This can place you in a lower income tax bracket, meaning you may pay less tax on the profit or on the capital gains. This strategy is great for retirees or those taking a break between jobs. Number 10, use a trust structure. If you have a significant amount of money to invest, using a discretionary trust can be really tax effective. It allows income and capital gains to be distributed to beneficiaries, often in a much lower tax brackets, reducing the overall tax paid. While trusts are great for larger investments, it may be less practical for smaller ones due to setup and ongoing cost. And lastly, strategy number 11, buying assets through a self-managed superannuation fund. With an SMSF, income is only taxed at 15%, except for Division 293. So if you don't earn 250K or more per annum, you don't have to stress about it, just ignore it. And if the fund sells assets it held for 12 months or more, the fund will get a that's for individuals. The fund will get a 1/3 CGT discount and the remaining balance will be taxed at 15% only. And once you retire and you enter in the pension phase, your income and capital gains will become tax-free. Just a heads up though, despite there is no minimum amount requirement to set up an SMSF, due to the high setup and ongoing compliance cost, an SMSF isn't practical unless you've got 200 to 500K to invest in it. And another downside of an SMSF is that you can't access the funds until you reach preservation age. So an SMSF is only great for those who's got cash flow outside of super. That's the end of this video, guys. If you found this video helpful, please give it a thumbs up.